Mastering risk management in algorithmic trading.
Algorithmic trading, or the use of computer programs to execute trading strategies based on predefined rules and criteria, has become increasingly popular in recent years. Algorithmic trading can offer many benefits, such as faster execution, lower transaction costs, reduced human error, and improved market efficiency. However, algorithmic trading also poses significant risks that need to be carefully managed and mitigated. In this video, I will discuss some of the key principles and practices of risk management in algorithmic trading and provide some examples for each point.
Point 1. Diversify intelligently. Don't put all your algorithms in one basket.
One of the most fundamental rules of risk management is diversification, or the practice of spreading your investments across different assets, markets, strategies, and time horizons. Diversification can help reduce the impact of market volatility, unexpected events, and individual losses on your overall portfolio performance. However, diversification is not a simple matter of adding more algorithms to your portfolio. You need to diversify intelligently, by considering the correlation, performance, and risk characteristics of each algorithm and how they interact with each other. For example, you should avoid overconcentration in a single market or asset class, as this can expose you to systemic risk or market shocks. You should also avoid over-reliance on a single strategy or style, as this can expose you to model risk or changing market conditions. Instead, you should aim for a balanced portfolio that includes algorithms with different objectives, approaches, and time frames, and that can perform well in different market scenarios.
Point 2. Learn to love drawdowns. They're inevitable, but managing them wisely is the key to long-term success. Drawdowns are periods of sustained losses or negative returns in your portfolio. They are inevitable in any form of trading, especially in algorithmic trading where you are subject to high-frequency fluctuations and market noise. Drawdowns can be stressful and demoralizing, but they are also an opportunity to learn and improve your trading performance. The key is to manage them wisely, by following these steps. Measure and monitor your drawdowns regularly. You should have a clear definition of what constitutes a drawdown for each algorithm and your portfolio as a whole, and track their frequency, duration, magnitude, and recovery time. Analyze the causes and sources of your drawdowns. You should identify whether your drawdowns are due to normal market fluctuations or specific events, whether they are isolated or systemic, whether they are within your expected range or exceed your thresholds, and whether they are related to your algorithm's performance or external factors. Take appropriate actions to mitigate your drawdowns. Depending on the nature and severity of your drawdowns, you may need to adjust your risk parameters, modify your algorithm's logic or parameters, pause or stop some of your algorithms temporarily or permanently, hedge your positions or reduce your exposure, or seek professional advice or assistance. Point 3. Risk is your co-pilot. Never let it take the driver's seat, but don't ignore its warnings. Risk is an inherent part of trading, and especially algorithmic trading where you are dealing with complex systems and uncertain outcomes. Risk can be both a friend and a foe. It can provide opportunities for profit as well as potential for loss. Therefore, you should never let risk take the driver's seat in your trading decisions, but you should also never ignore its warnings or signals. You should always have a clear understanding of the risks involved in each algorithm and your portfolio as a whole, and have a robust framework for measuring, monitoring, and managing them. Some of the essential elements of risk management in algorithmic trading are setting clear investment goals and risk tolerance levels for each algorithm and your portfolio as a whole, diversifying your investments and avoiding overconcentration, regularly monitoring and evaluating your algorithm's performance and risk exposure, setting stop-loss and profit-taking levels for each algorithm and your portfolio as a whole, implementing risk mitigation strategies such as hedging and position sizing, conducting thorough research and due diligence on your trading strategies and markets, testing and validating your algorithms before deploying them live, implementing effective controls and safeguards to prevent errors, malfunctions, frauds, or cyber attacks, reviewing and updating your risk management policies and procedures periodically. By following these principles and practices of risk management and algorithmic trading, you can enhance your trading performance, protect your capital, preserve your profits, and avoid catastrophic losses. Happy trading!